Hello, all the CA inter students. Now, this is a time for some expected areas in clubbing of income chapter. If you listen to this particular lecture, it's a very short one. Definitely all doubts cleared and any kind of risky areas in clubbing, the expected areas for the examination I have covered in this. So let's go into that very fastly. Number one, clubbing of income provisions, section number 60. Okay, there are four important concepts which we need to cover for this exam. I'm covering all the four. Section 60, transfer of income and no transfer of asset. Means what? Income is getting transferred from one person to another person, but he's not transferring the asset. For example, if you transfer with the house property, I will be the owner and I will get the rent. Okay, so that is ideally understandable. Okay, but what the person is doing, he is not transferring the house property. He is transferring only the rental income on that house property. House belongs to me. Rental income I am asking tenant to deposit in your account. In such case, your income also will be taxable in my hands only. So taxpayer owns an asset. Example ke house property. Any asset it can be. Ownership of asset is not transferred. In other words, he is retaining the ownership. The income from the asset is transferred to any person under any agreement or arrangement, anything. Okay, income is transferred to any person. The above transfer may be revocable or may not be revocable. Means income will be transferred. How much time? Maybe indefinitely till the lifetime of the other person, or maybe for 4 or 5 years. I can revoke at any time. Above transfer can be affected at any time. During the previous year, any time it can be affected. Okay. So if income is transferred on an asset without transferring the asset itself, the income from that asset which is transferred to other person will be chargeable to tax not under that person's hand. It will be taxable under the transferor's hand only. Over. Okay. So hardly we have taken 1.5 minutes to cover this. Next one. Section number 61. Revocable transfer of assets. Now I'm not transferring the income, I'm transferring assets. Lengthy concept, not lengthy means not in 10-15 minutes, 2-3 minutes it will take. Let me explain the 5 different situations where there is a revocable transfer of assets. Okay, revocable transfer of assets means what? I am transferring the asset. Okay, when you transfer the asset, what will happen automatically? Asset when transferred to some person, income on that asset also will be chargeable under his hands only. However, transfer if it is absolute, this is a rule. Sometimes there will be a revocable transfer. Sometimes there will be revocable transfer. What do you mean by a revocable transfer? Revoke means a take back. Means what? I am transferring asset to another person, but I can take back that asset at any time. 5 situations in that 4 are very much relevant. Number 1, asset transferred under trust. Revocable in the lifetime of the beneficiary. Means what? I transferred asset to a trust to provide benefits to beneficiary. But during the lifetime of beneficiary itself, I have a right to take that asset back. In such case, it's a revocable transfer. Second kind of revocable transfer. Other than trust, okay, Mr. A transferred asset to Mr. B, okay, transferred asset to Mr. B, and he said that I can revoke the transfer at any time during the lifetime of the transferee. A transferred to B an asset and said that at any time in your life I can again take back the asset. This is also a revocable transfer. Okay, next, third one. This is not relevant to today. Asset transferred before non-for 1961 and revocable within 6 months. This is 6 years. This is irrelevant now. Now defunctional. So fourth point, transfer contains any provision. Means when A transferred asset to B, in the transfer deed itself we have written asset will be retransferred either directly or indirectly. Indirectly means what? Asset will be given to wife of Mr. X. Automatically it will be reaching X at the end of the day. So indirect transfer or direct transfer, anything. So first one, asset transferred under trust but revocable in the lifetime of the beneficiary. Asset transferred to a person and revocable during the lifetime of the transferee. Asset transferred but there is a provision for retransfer, whether directly or indirectly. Or transfer has a right to reassume power over the asset or income. Means what? I transferred, but I have a right to reassume the power over it. Okay, anytime I can take back that asset. It is also similar to that of revocation. These all are revocable transfer of assets. Now, in all these cases, there is a transfer, but it is revocable, taken back during the lifetime of the transferee. In such case, income from such asset will be chargeable to tax under the hands of the transferor who made a revocable transfer. So there are 2 important points. Important point 1, income from the asset is taxable in the hands of transferor. Understandable. Important point 2, taxability arises on assuming such power, not an actual exercise. Sir, I didn't understand. See, Today we entered into agreement. Today we entered into agreement that I'm transferring you asset, but any time in the next 7 years I can take back. Okay, 7 years when he will take back, we don't know. Law says that agreement is entered for transfer. A, B entered into agreement to transfer asset. Yes, that transfer agreement la retransfer is there. Yes, which day? Today. Today itself retransfer is agreed. The date on which you agreed to have revocation chance, from that day itself income will be included, not on actual exercise of power and revocation. So actual revocation is not important. Understood? So whether you have a revocation power, yes, when from today, then from today itself income will be included into the hands of the transferor. So around 3.5 minutes it has taken to complete this. Next one. Clubbing of spouses remuneration. Very, very important. Okay. Okay. Clubbing of spouses remuneration. See here. First, taxpayer is an individual. Taxpayer, hey, listen, this is very important point. Expected question, so one question. Taxpayer is an individual. He has a substantial interest in a concern. What do you mean by substantial interest? Equity shares of a company, like 20% or more, either me or along with my relatives, we are holding. If it is a partnership firm, in the capital, 20% or more should be held by me or by my relatives, along with my relatives. Then I call it as a substantial interest. Okay, there is an individual taxpayer, and that individual taxpayer is having a substantial interest in any concern. Okay. Spouse of the taxpayer is employed in the above mentioned concern. Means what? For example, Mr. A is having substantial interest in a company. In that company, Mrs. A became an employee, receiving salary income. Salary means any type of salary under section 15 to 17. Okay. Salary income is received by her, or vice versa. She is having substantial interest, he is an employee in that company, then he is getting any salary. So spouse is employed in a concern. That spouse who is employed has no technical or professional knowledge. In that case, see, what are the four conditions? Taxpayer is an individual, he or she is having substantial interest, he or her spouse is appointed as an employee in the same company without any technical qualification. If all these are satisfied, salary income of that particular spouse will be included into the remuneration of the other person who is having substantial interest. Who is having substantial interest? Here, who is having substantial interest in our first example? A is having substantial interest. Therefore, this salary income of Mrs. A, who is a salaried employee without technical qualification, her salary income is assumed because of the substantial interest of the husband. Therefore, it will be added to his income. This is the logic. Okay. So tax flow in the hands of individual taxpayer who is having substantial interest. Okay. Now doubt will come. Sir, what if both are having substantial interest and both do not have technical qualification? See, I have created 4 different situations. Beyond this, question will not come. Okay. Both husband and wife have substantial interest. Next, both are in the receipt of remuneration. Next, these are all examples. Examples you can read later. Mainly points I am talking. 1, 2. So both wife and husband are having substantial interest. Next, both are in the receipt of remuneration. Next, remuneration is received without technical qualification. Then what will happen? Then remuneration will be included in the total income of the husband or wife whose total income excluding such remuneration is greater. Do you know what does it mean? For example, hey, listen, 2 important points you need to understand again here. Number 1, salary income ke clubbing, not clubbing of other sources of income. Salary income ke clubbing occurs. Okay. Salary income of Mrs. A is added to Mr. A. After adding it, okay, after adding it, salary whose total income is, listening everyone, sir, listen carefully. Husband, wife, A, Mrs. A, both are there, both are having substantial interest, both are not having technical qualification, then what will happen? Then whose income line need to club? Both are having substantial interest, both are not having technical qualification. Then what to do? Then in whose income? Check without including this remuneration, check whose total income is higher. A's total income is higher, merged with his income. Now, second year, next year, even in the next year, even though the total income is lesser for A, more for Mrs. A, even then clubbing occurs in the same way. What does it mean? Once clubbing is done in one pattern, that will be followed till assessing officer decide to change. If assessing officer decides to change that, no, this time let's club in the hands of Mrs. A, then do. Or else, irrespective of whose total income is higher, it will be clubbed only with the total income of that individual in whose total income first clubbing happened. Okay. So if once clubbing is done in the hands of X, salary of X and Mrs. X is included into the income of X. In subsequent years, even if income of X is lower than Mrs. X in that year, in such case, assessing officer can club income of X and Mrs. X in the hands of Mrs. X only if assessing officer is satisfied that it is necessary to do so. Okay. So normally, once time decision is taken, applicable forever in the same clubbing nature. I have given one question also. Okay. Expected question for this exam. Income of X 31 years, Mrs. X 28 years. Salary income after standard deduction. Salary income X, Mrs. X. Business income 10 lakh, 1 lakh 70. Okay. And income from other sources. Income from other sources 3 lakh 70, 40. Total income tax given. X is employed by B Limited. X is employed by B Limited. Okay, salary 40,000 per month and 2 months salary given as an advance, given as a bonus. 40,000 into 12, 4 lakh 80, 4 lakh 80 plus another 8, 40,000 for 12 months, 2 months salary is given as a bonus. 2 months salary is given as a bonus. Both together, everything, including standard deduction, it came to 5 lakh 10,000. Next, without any technical qualification. So, what are the points here? Mrs. X is having substantial interest. 20% substantial interest. For 10 days, she is having substantial. For 11 days, even then, income clubbing will happen. It need not be for full year substantial interest. Even one day, if she is having substantial interest, clubbing provisions will get activated for that previous year. Okay. Substantial interest is there. Mr. X is in receipt of which income? Salary income. Clubbing do not happen for other incomes. Clubbing happen only for salary income. Okay. Now, what is the salary income of Mr. X? 5 lakh 10. That will be now merged in the salary income of Mrs. X. That's why 5 lakh 10,000. Remaining incomes they will be taking recomputation of tax. Okay. Next, individual taxed in income of assets transferred to the spouse. Okay. Very, 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 very important. Expected question for this examination. 90% this will come. Okay. There are two important topics here. This one and this one. A very big question also I have given. Minor income clubbing. First I will discuss about minor income clubbing, then I will go there. Minor income. Taxable in whose hands? Taxable in the hands of the parent whose total income before including that minor income is higher. Sir, if parents are separated, then guardian. Death also same. Okay. Number two. Next, no clubbing cases. When clubbing will not happen? If the minor is if the minor is suffering from some kind of irregularity or inability defined under 80U. Next, minor manual work money came, or because of his skill and talent money came, then minor only will be assessed to tax. If minor income is included into the total income of the parent, parent will be eligible to parent will be eligible to an exemption under section 10 class 32 to the extent of 1500 rupees for each minor, but this exemption is not available if you go with alternate tax regime. Okay, is that point? See, take a snap and you can do. This is the question that will be tested in the next coming exam. Okay, take a snap. Whatever I said now, same given as a numerical example. But if you can solve this, no need to do any other question. Minorly, this is a fantastic question that I have compiled. Just to take a snap or pause the video, see the question and do. Same question will come in examination. If at all, it has to be given. Next, last part. Individual taxed on income on assets transferred to spouse. What does it mean? Now what we read, whenever assets are transferred, a revocable transfer happened, income is taxable. I did not do revocable transfer. I did irrevocable transfer. But without adequate consideration, I have done. Without adequate consideration, we have done. So let us see the conditions. Taxpayer is an individual. He or she transferred an asset other than house property, because house property, if it is transferred without adequate consideration, deemed income will come under section 27 of house property itself. So it won't fall under the clubbing provisions. Okay, deemed owner concept is there in house property chapter. That will get attracted. Okay, so taxpayer is individual and one of the spouse has transferred an asset other than house property, means shares or debentures or something like that. Asset is transferred to his or her spouse. That spouse relation should be existed on the date of transfer and also on the date of income earning. Okay, transfer date they are not wife and husband. Income generation time they are no clubbing. Or transfer date they are, but income generation time they departed, they divided together. Okay, in that case also it won't. So in order to attract this section, the relationship of wife and husband should be subsisting on both the dates, date of transfer as well as the date of income received. Transfer may be direct or indirect. The asset is transferred otherwise than for adequate consideration or connection with an agreement to live apart. Means court said that both of them divorce and live apart. In that case, they divided. That will not be coming here. So it should be without an adequate consideration and it should be not with an agreement to live apart. Next, the asset may be held by the transferee spouse either in the same form or in a different form. See, let's compile everything. Point number one. Taxpayer is an individual. Okay. That individual is having an asset. Okay. That asset has been transferred by him to the spouse. Very good. Next one. That should be other than house property. Very good. Next, that asset is transferred without an adequate consideration or without an agreement to live apart. In such case, and that asset is held by the recipient assessee either in the same form or in a different form. Examples also I have written here. See here. Husband gifted cash to wife. Wife deposited that in the bank. Bank gave interest. This interest will be taxable in the hands of the husband. Okay. Next. Wife gifted cash to husband. Husband purchased house property. From that house property, income came, rental income. That is also taxable and included into the total income of the wife who gave the gift. So, taxpayer is an individual and transferred an asset other than house property without an adequate consideration, and it may be direct or indirect transfer without adequate consideration, and the transferee spouse may be holding it either in the same form or in a different form. Any income that generated from that asset will be taxable in the hands of the transferee spouse who gave that asset. Okay. Now, problem is not about this. Up to here, everything is in control. But the problem is, for example, husband gave cash to wife. Wife purchased debentures out of it. Interest will be clubbed in the hands of husband. Wife gave gift to husband. Husband purchased house property. Income from house property clubbed in the hands of wife. Okay. Clubbed in the hands of wife. Okay. So, sir, house property not included, you said, na? Hey, what I said, transferred asset should not be house property. Wife gave cash to husband. With that cash, husband purchased house property. Now, transferred asset is not house property, na? Transferred asset is a cash. With the cash, I purchased house property. From that income came, income will be merged and clubbed in the hands of, included into the total income of wife. Understandable. But that is not the story. The most difficult part will start now. Husband gave gift to wife. Wife invested that money in the business. Invested that money in the business. Now business will generate income. In that income, there is a gifted part of money. There is a non-gifted own money. Okay. Then how to calculate the income that will be apportioned to the gifted part? For that, this particular concept came. 99% this question will come in the tomorrow's examination. Chance is there. Okay. See here. Asset gifted is transferred to business. How clubbing attracts. Okay. There are 4 steps in this. Okay. Forget about act. This is not the time to learn about what is there in the bare provisions. No. This is a time question comes how to do. First, find out the total investment of the transferee spouse in the business on the first day of the previous year. Hey, this is important. First day of the previous year is important. Okay. Not during the year. So first one, find out the total investment of the transfer spouse in the business. Total investment, not the gifted investment. Total investment at the beginning of every previous year. Okay, condition number 1 understood. Next one, find out the amount invested by the transferee spouse. Hey, spouse cash, spouse gift only should be considered. Grandfather, okay, mother side persons, all ignore. We are not doing gift taxation. We are doing clubbing provisions between the spouses. So spouse gifted money only will be included into this. Okay. Find out the amount invested by the transferee spouse out of the assets transferred to her without adequate consideration by her husband on the first day of the previous year in the said business. So whatever the amount that was received, by her from her husband or by him from his wife at the beginning day of the previous year, you need to consider, not during the year. Beginning whatever is received, that money you need to consider. Okay. So find out the total investment. Next one, how much amount is invested by the transferee spouse out of the assets given by the assets transferred to her without adequate consideration by her husband, vice versa, on the first day of the previous year. Next, find out the taxable income. If any disallowances are there, add, reduce, everything, all these things you take. Okay, exempt income will not be included. Next, share of profit will not be considered. Only interest if there is if it is a partnership from where the money is invested. interest part will be considered. Okay. Find out the amount which shall be included in the hands of transferor is determined as per step 3 into step 2 divided by step 1. Rather than seeing like this, I will show one illustration. Properly put your mind here and listen. 5 minutes we will complete, clubbing will be over. Okay. See, on December 27, 2023, at a 23-24 previous year, X gifts, okay, 2,50,000 to Mrs. X and a wife. Mrs. X has taken this 2,50,000 and starts business on Jan 20, 2024. Okay. By investing how much? 8,50,000. If I give 2,50,000, how can she invest 8,50,000? Because that will be invested by other money. 2,50,000 gift. Remaining gifts you should not consider. Na? So 1,50,000, 2,00,000, 3,50,000, 4,50,000, 5,60,000, 6,00,000. 6,00,000 plus 2,50,000, 8,50,000. Perfect. So 8,50,000 has been invested by her. On which date? Jan 20. Already we read in the yesterday's class, na, revision what I said. Previous year of a newly started business will start on the day on which it was started. So 20th January she started, na, that will be the first day of the previous year. Totally, what is the step 1? Find out the total investment of the spouse. 8,50,000. Okay. Next, find out the amount invested by the transferee spouse. Okay. Invested by transferee spouse out of the gift given. How much? 2,50,000. Okay. Done. Next one. Find out the taxable income of the transferee spouse. Let us calculate her taxable income for that particular year first. Which year? 23-24. Okay. 23-24. Let us see. 23-24 ki what is the profit? Already computed na 2 lakh. What is the profit? 2 lakh. Okay. Next, after that, amount which shall be included into the hands of the transferor is divided, is calculated as such. Now listen, 8,50,000 is the capital. For that 8,50,000, I got a profit of 2 lakh. And in that 2,50,000 is there, extra 6 lakh is also there. So how to calculate? If 8,50,000 has given 2 lakh rupee profit, 2 lakh rupee profit, how much 2,50,000 will give you? For that we need to do calculation. Okay, for that we need to do calculation. How to do? Take calculator once. Take calculator once. 2,50,000 divided by 8,50,000 into 2 lakhs. 58,823. That will be clubbed in the hands of that individual. 58,823. Exactly. 58,823.52 I got. Answer is 58,824. Second year. For the second year also they gave the details. See, profit computed na, balance as on 1st April 24, 9,80,000. Fresh capital gifted again by X. On which date? April 10th, 2024. But you should not consider in that year because this was not at the beginning of that year. Only on the day one, first day, whatever is there, that only you need to consider. So first day, how much is the capital? 9,80,000. So same thing. Second year, if you have to compute, it look like this. See, 9,80,000 is the total investment. Next, in that 9,80,000, see here, fresh capital gift is given. Not on the day one, na, it is on April 10th. That should not be considered that year. So what is the gifted amount till now? 2,50,000. Last year gift amount is there. 2,50,000. Next, how much is the taxable income? Taxable profit is 6 lakh rupee. But they have given one thing. For the previous year 24-25, okay, 23-24 we have done. 24-25, 28,000 is not deductible because it's a cash payment. Excess of 10,000 like cash payment is disallowed. Na? So 6,28,000 after adding it. So now again recompute. What amount will be clubbed in the transferor hands? Take calculator. Okay. If 9,80,000 ki 6,28,000 came, 6,28,000 came. For 2,50,000, how much should be there? 2,50,000 divided by 9,80,000 into 6,28,000. 160,204. Perfect. 160,204. Same again. Now this gift will be this gift. Where is that gift? This gift, old gift. 1 lakh, 2 lakh 50, 3 lakh 50 will be the total gifted amount now. Yes, that's it. Same computation. Okay. Do this without fail. That's it. This is all the end of the concept of clubbing of income. Okay. Thank you very much. We'll come up with set off and carry forward.